Welcome to the channel. I'm the Swedish dividend investor. Do you know what is annoying being a YouTuber who covers the stock market? Well, I'll tell you. So, on Wednesday, I checked my watch list and I saw 4 companies trading pretty low. And when I did my research for the video, they all offered over 9% annual return. So what's the problem? As you know, the stock market moves fast, and I usually prepare and record my videos between Friday and Saturday. On Thursday, all 4 stocks moved over 3%. So, yeah. Anyway, I want to take a look into a company I have had on my watch list for some time. And as you have probably seen from the title, let's dive into it. If you're new here, remember to hit like, subscribe and leave a comment. Make sure to read the disclaimer in the description down below. Bristol-Myers Squibb is a leading global biopharmaceutical company focused on discovering, developing and delivering innovative medicines for serious diseases. Headquartered in New York City, BMY operates in key therapeutic areas including oncology, immunology, cardiovascular and hematology. The company's portfolio includes blockbuster drugs like Opdivo and Yervoy, Eliquis and Revlimid, with ongoing R&D efforts aimed at strengthening its pipeline. BMY significantly expanded its capabilities with the acquisition of Celgene in 2019 and continues to invest heavily in biologics and cell therapies. Their business strategy emphasizes high-value therapies, strategic partnerships and a strong commitment to innovation in areas of unmet medical need. We can see they have taken a beating as of lately, down over 26% for the 5-year period. But just because a stock is beaten down doesn't mean it's a good or bad investment. It all comes around to what value you get. As per usual, I have punched in their numbers in my spreadsheet. I do the legwork so you don't have to. Let's start out with the charts. The first we see is somewhat stable cash flow and a growing dividend. To the right we can see pretty steady revenue, but earning is going all over the place. For the balance sheet we can see they have some cash, but the debt is piling on after a few years of paying it down. Let's go over their quick stats. I'm just going through the ones I care the most about. They have a dividend over 2.5%, currently 5.13. Negative PE, we will get to this later. Free cash flow growth, yes. Free cash flow payout of 36%, yes, and very nice. Revenue growth, yes. Net income growth, not really. Decreasing shares. Their debt is covered in 5 years with their cash flow. Their cash cover 1/4 of their debt, and their multiple times their 5-year average free cash flow is higher than their market cap, which is $95 billion. Scrolling down to their numbers, we see a beautiful cash flow segment. Massive cash flow, and the price to cash flow is at 7. Very nice. Currently, it is a cash flow yield of 14%. Low dividend payout if we look at the cash flows. Their net income, however, is not so stellar. Reading their 10K, I found out it's because of acquisitions during 2024. The acquisition of Karuna was around $12 billion. Hey, you gotta spend money to make money, right? Time will tell if they made a smart investment. We can see the shares outstanding here, going down, so we are not getting diluted. Otherwise, nothing too crazy here. Maybe just the debt raises some red flags. We can see my notes. Their dividend growth has been between 5 and 7% for the 3 to 10 year period. Dividend growth of 8 years and 35 years of consecutive dividend payments. Very nice to see. Let's not beat around the bush and do the valuation. As always, we have 3 cases, normal, best and worst, and we use a 10% discount rate, our required return. We will do valuation on the free cash flow, dividend and earnings. Let's start with the free cash flow. For the normal case, I've used 2% growth and a terminal multiple of 7. giving us a present value of $133.92 billion. Remember, this is compared to the market cap of $95 billion. For the best case, I've used 3% growth and a terminal multiple of 9, giving us a present value of $155.85 billion. Damn. Alright, let's do the last case for the cash flow. Negative 1% for the growth and a multiple of 5, landing at a present value of $102.26 billion. So, with a probability of 60-20-20 for each case, we land at a fair price of $131.97 billion. And with a 10% margin of safety, we need to buy below $118.78 billion. That's insane. But that's just the valuation for the free cash flow. Let's head over to the dividend valuation. 10% discount rate here as well. I snatched the growth numbers from Seeking Alpha, and for normal case I went with 5% growth and a terminal multiple of 25, so a 4% yield at the end of the calculation. We land at a present value of $56.46. This is per share. For the best case, 6% growth and a terminal multiple of 30, so 3.33% yield at year 10. We land at a present value of $68.81. For the worst case, I've gone with 2% growth and a terminal multiple of 18, so a 5.55% yield at year 10. Present value $37.33. 60-20-20 probability. We see the fair price is sitting at $55.10, and with a 10% margin of safety, we would need to buy at $49.59. That's awesome. Now, the earnings part was a bit tough. Since the earnings were all over the place, I went with a normalized earnings of $5 billion. So, for the normal case, I went with 3% growth and a multiple of 15. Present value of $73.18 billion. Best case, 5% growth and a multiple of 20. Present value, $98.87 billion. Worst case, 1% growth and a multiple of 8. Present value of $49.08 billion. 60-20-20 probability. We see a fair market cap price of $73.50 billion, and with a margin of safety of 10%, we would need to buy at a market cap below $66.15. Now, take that with a grain of salt. Their earnings will look messy, but I think we should focus more on their cash flow, since earnings can be manipulated more easily than cash flow. Let's go to the main page. Looking at the intrinsic value, we can see the dividend and free cash flow valuation is green, meaning undervaluation, and the earnings is showing red. Looking at the mixed valuation, where I take the 3 valuations and make an average, this is per share adjusted. We can see their fair value is $52.16 and $47.41 with a margin of safety of 10%. So, just based on the numbers, I would say BMY is looking like a buy. I think we could expect 10 to 12% returns annually from BMY if the growth plays out. One thing to keep in mind with healthcare companies is their pipeline of drugs and patents. I'm not an expert on drugs, so I will leave that for you to dig deeper into. Now, I was eyeing them when they were close to hit 6% dividend yield during 2024, but I didn't pull the trigger. On Wednesday, they were a bit lower than they are today, but I don't think it's impossible for them to hit the low 40s or even dip down to high 30s. With talks from the administration about lowering drug prices, BMY could face headwinds. This company reminds me of when I bought AbbVie. AbbVie's PE has been terrible, but looking under the hood, their cash flow was stellar. The market was a bit panicky about their blockbuster drug, Humira, losing its patent, but they had acquired Botox and they had some good drugs in their pipeline. AbbVie was the first investment where I doubled my money. I could see myself buying BMY if they go down to a low $40. Who knows when that will happen? What do you think about BMY? Let me know in the comments. If you liked the video, give it a thumbs up, support me by subscribing and hit the bell icon so you don't miss any updates. I'm the Swedish dividend investor and I will see you in the next one. Stay smart, stay patient and keep stacking those dividends. Ha det gött!